Yeah, I'm over that.
Yeah, I hear you. Is that Shaq or Jordan in the background over your left shoulder?
That's MJ.
MJ,
That's
yeah, okay.
a.
It's
Oh
blurry
no,
because of
it's
the filter you got. So
yeah, it's
it's
supposed to be a certified autographed MJ
wow.
portrait by Joey Zappella. It's number I think 87 of only 750. It's
Did
got
you
a
hear about his latest venture? There's a sporting
MJ.
company. Yeah, he owns a share in a big sporting company. Spring something. It's a Swiss-based outfit.
Yeah, I
They're
read
going
about that.
public and they're
Yeah, I think it
valued
was
at
like
like
8 billion.
$8 billion or something.
Yeah,
Yeah,
yeah.
so he's done well out of that little investment.
Did you watch
Uh,
did you watch The Last Dance? It's a little while ago on Netflix, but did you catch
yeah,
that?
it's on my, you know how stuff gets added to your watch later list and you never get to it? It's on there.
Oh, you haven't watched it yet?
No, not yet, not
Oh
yet.
man,
I'm a Lakers fan. I'm like, I love MJ, great,
if
all
you're a
that. I get
basketball
it.
fan, you'll be a
I
fan
know,
of
I
this
know,
show.
I know, I know. It's on my list. I will watch it.
The last one that came up was the Malice at the Palace. Have you seen
Mm-hmm.
that? Insane.
Yeah. Reggie Miller's photo was on it in terms of as the selling point.
Yeah,
To
yeah.
me, he's a UCLA Bruin. I went to UCLA as well,
All
but
right.
I did not like him in NBA, man. He was just this annoying little 3-point shooter, at the
Why?
Pacers,
Because he was good.
Yeah, and he didn't play for Lakers. So, you
There's a
know,
lot. There's a
uh,
lot of greats that didn't play for the Lakers,
yeah, I
Banu.
know, I know, I know.
So
You
it's
appreciate them, but he just, he used to get under what's his name. He had the Knicks number though. He used to get into Patrick Ewing's skin pretty
31.
quickly.
Yeah,
Yeah, he would get into there pretty quickly. No, good
yeah,
player, good player.
yeah. I think one of the most. I think Iverson was like super underrated. It's only now I
Yeah,
look back and think how Iverson was just quick, sleek,
yeah,
and
yeah,
there's just some highlights I've seen with him against Jordan, and he literally cripples Jordan, just
yeah.
twists
He's
Jordan's
very quick,
ankles.
very
Insane.
quick. Yeah, I mean the
Yeah,
age difference too, very quick. But yeah, no, Iverson was pretty damn good. He didn't last
yeah.
very long though, did he? How
Iverson.
long did he play? Yeah, how long did he
Yeah, I
play?
don't
Like
know. I don't know.
he kind of faded away. Last I heard, he was going through bankruptcy.
That's
Uh,
that's a fascinating thing about a lot of these
yeah,
high profile sports people, right? Like they make a
yeah,
ton of money, and then Shaq speaks a lot about this in a
yeah,
number of like US podcasts where he talks about how he made his first million, and then he didn't realize you got to pay tax on that, this tax, that tax, and he's buying his
yeah.
mum a car, his dad a car,
And
and then
before you know it,
his advisor's like, "You got no money left." He's like, "How do I have no money left, man? I just made $1 million."
yeah.
Hello and welcome, everyone. I'm Robert Baharian, and this is Masters in Investing. On this show, I talk to guests about financial markets, the economy, investing, and business. Don't forget to subscribe and leave us an awesome review. Let's get into it. My guest today is Bhanu Singh, Head of Asia Pacific Portfolio Management at Dimensional. Bhanu is responsible for all portfolios managed out of Dimensional's offices in Australia, Singapore, and Japan. He's also a member of Dimensional's Investment Research Committee and serves as a director for Dimensional Australia. During our conversation today, we talk about mega-cap stocks and their future outlook. We talk about the odds of a market correction, marijuana ETFs, and a whole bunch more. Let's get into it. Bhanu Singh, welcome to Masters Investing, man. Thanks for joining me today.
Thanks for having me, Robert.
Might get straight into it. Markets are at all-time highs, properties, all-time highs, jobs, all-time lows, interest rates, all-time lows, inflation breaking out at the highest it's ever been for the last however many years, 10 or 15 years. What do investors make of all of this?
Well, I can't speak about all investors, but in my humble opinion, it's par for the course. Markets are forward-looking. So they're looking forward and saying, we've just come out of a pandemic and we're not quite out yet, by the way. Like, we're worried about the Delta variant. Hopefully there's not another one, but if there is another one that's even more contagious or something, who knows? So there's still a lot of uncertainty. But I think you're just coming out of a period where economic activity was much lower. So if you're looking at, for example, the jobs number today, to say, hey, what's the economic activity now? And I need to relate that to the market level now. That's a futile exercise, right? Because markets are looking forward to saying what's going to happen into the future, what's our best estimate of future revenues, future profitability, and based on that, what price does it make sense to pay? Let's talk just overall level of markets. So based on that, your guess is as good as mine. Markets move around a lot. When there's a lot of uncertainty, markets move around quickly. So when March happened, 2020, there was just a huge amount of uncertainty. One thing was clear, that this was going to impact economic activity. The problem was nobody knew how much. Nobody knew that you're going to have these worldwide shutdowns and carbon emissions at the lowest in the last 5 years, kind of thing. Like pretty serious reduction in economic activity. So perhaps that warranted the drop that we saw in 30-40%, depending on which market you look at. And then you look at just a few months later, vaccines are out, economic activity in places like US is picking up, and that's giving a lot of hope to people to say, okay, we're coming out of this thing. Now you might say, hey, we're still getting, Sydney 800 cases a day. We're not out of it yet. Most of the world is not vaccinated, but that's today, right? That's already priced in. Markets looking forward going, compared to 2 years ago, when we didn't even have a vaccine, had no idea what this thing was going to do. I mean, people forget 1918, we lost 60 million people by some estimates in that flu epidemic, right? So that's maybe one end of the extreme. And so compared to that, things are looking pretty good right now. We got 3-4 vaccines that are highly effective, 90 plus. We got a bunch of other ones roaming around at 80 plus. Governments are mobilizing to vaccinate people as quickly as they can. There's sort of light at the end of the tunnel. So maybe some of these valuations are justified. The truth is, we don't know what the right level of markets is. So what we see in the markets is our best estimate. And that's how we view the world. Markets are telling you that at this level, they're willing to trade and exchange capital. So they're telling you what their expectations are about the future. And that's useful information.
I think it was the S&P 500 that's made like 5 days in a row with all-time highs like last week. And I think if we're on track now, I think the S&P 500 will, if it continues on the trend that it's currently where we're at today, I think it's going to be the longest streak for the last, I think, almost 25, 30 years in financial markets. And we've got all-time highs. We've got profit margins in the S&P 500 as an aggregate at all-time highs. And I spoke with Tim Farrelly in last week's episode. And we were talking about how in markets, currently we've got profits at all-time highs, profit margins at all-time highs, and stock market valuations at all-time highs. It was really interesting. He said, well, that's what you want stocks to do. You want stocks to continue to grow, to continue to make profit and continue to make record revenue and record net profits as well. What does that say, though, for where we are now? I mean, we're pretty high on this, mountaintop, if you like, and we're looking out to the distance and we really can't see what's going on. You make references before about markets being forward-looking. I mean, that's all good and well, but forward-looking what? Next 6 months, next 12 months, next 5 years? Like, how do we...
Depends on the metric you're looking at. Depends on the metric you're looking at. So you might be an investor saving for your next down payment on a house, and your investment horizon for that investment might be 6 to 12 months, right? You might be an insurance company hedging out future payments on their products you've underwritten, and that liability might be 10 years. You might be the endowment fund of a major university where their investment horizon is 50 years, or a sovereign wealth fund where it's 50 years. So who knows? It depends on different investors. Now, if you can start talking about, hey, what's my investment horizon and what do I feel about risk in the market? Then you can say something specific about what you should or should not hold, maybe, right? So if you're that individual who's saving for the house to buy in the next 6 to 12 months, maybe don't put it in the equity market, because that thing swings 30-40% at times within the space of 6 months. Maybe not a good idea. Maybe your asset allocation should be a bit more safe because you want that money to be around in 12 months to be able to make the down payment, right? So that's a different scenario. But if we're talking things like S&P 500 type aggregate metrics, GDP growth, these type really high level numbers, then it is by definition a mix of all of those investment horizons, all of those different risk tolerances and risk appetites, whatever you want to call it. And so that's the number you get. That's the problem with looking at market levels. It may be very relevant for one individual and not all that relevant for somebody else. So our funds, we're looking forward to say, what is it telling me about expected returns to say stock A versus stock B, or fixed income, US curve is looking this attractive versus the UK curve. Where do I go position my fund? We have a long-term investment horizon, but we know, for example, that a month from now, that picture might be very different.
Or in a week from now.
A week from now, a day from now. So the question then is to say, what do I do about it? If the picture is sufficiently different, then it might make sense for me to do a trade, to reposition the portfolio. And we do that every day. But if it's not all that different, then maybe don't do anything. Just, things are as they were. So I think people often get fixated on these high level numbers where the market high level is. And I agree with that point earlier that, that's what you want stocks to do. As the profits are going up, markets should go up.
It's like people are afraid of that. Like when that's happening, people are afraid of it because there's a viewpoint that says, well, if markets have been going up for this long, admittingly, we have had these jolts since the GFC, right? I think we've been in a bull market since the GFC, just with some hurdles along the way, quite frankly. I just don't think we've seen these huge, we've seen drawdowns, certainly not to the magnitude and certainly not to the duration that we saw since the GFC.
Yeah. And there's nothing to say that there should be that pattern. I think in some ways we have been living in that world a little bit. So you read a lot of news about how...
What's that? As in that we should have that type of pattern?
Well, like late 90s, right? Tech boom happened, then it crashed. And then we had a good run from 2000-ish to 2008, and then that happened. And because of those two events, I feel like sometimes people just have it in the back of their head going, oh, every 10 years or so, we're going to have a crash. And that may or may not be right, but there's no reason, there's no information in those two events to tell you that the next 10-year number is going to, look a certain way. So it could be that we might as well be on a 30-year sustained bull run. I don't know.
It's almost like, I think you're right. And, if you go to when you could go to a casino and you walk the roulette tables, for example, if you see a table spinning black, and you're betting on red, you're like, has to be red. Has to be red, right?
Those are independent variables. They're
independent variables, right? But,
yeah, exactly. And random.
And totally random. Yeah. But unless you're thinking about it that way, I think investors don't look at it that way. They look at it as, well, it's gone too long. It's been too many spins of black. It has to be red now. It's inevitable. So I'll continue betting until it hits red. And who knows how much money you lose betting against that trend, so to speak, even though it's independent variables, before you even make any money on that. And there's a lot of stuff that I'm sure you're reading as well. There's a lot of commentators talking about the market's done 20% last year. It can't do that again. So be prepared for a drawdown. Like how much validity is in that statement that these people make?
Yeah. There's a whole host of literature around all this stuff, because I think some of the stuff you're talking about, how, it's been up 10% a year for the last 5 years. There's got to be a negative one.
It's never done this before.
It's just one of those emotional things where you're trying to make sense of something that's purely a random variable. And you tend to attach these sort of patterns. I mean, for example, we have, I shouldn't badger a whole discipline. We have people who follow technical things on charts to say, head and shoulder patterns and all that. There's no evidence that any of that works. But I think it's just looking for patterns where they don't exist. That's natural. People do that all the time.
Why do we do that, Bhanu?
Ken Friend says back in the day, if you were walking around the savannah and you thought you saw a shadow on the grass somewhere, the people who said, I think that's a lion, run, probably lived, even if, so all the times when it was a lion, they lived. And if you said, I don't think that's lion, that's just, wind moving the grass, and they died, they got cleaned out of the gene pool. So that's just funny. He jokes about it. It's just natural tendency for people to do that. But the problem is, let's talk about a couple of things you mentioned earlier. Inflation. You said an all-time highs, and there has been some data that talks about inflation being high. The challenge is we don't know whether that's transitory or permanent. But you remember GFC? Fed comes out with that TALF and all that, big $800 billion being injected. The next week, everybody's talking, we're going to get hyperinflation. Here comes inflation. Here comes really high interest rates. 13 years later, we're still waiting for those really high interest rates. Right?
I mean, the headlines were, And I quote, Federal Reserve officials are increasingly worried that inflation is too low and could lead the central bank with less room to maneuver in an economic downturn. It's 2 years ago.
Yeah.
And then
so
literally next minute,
sudden,
everything screams inflation.
Yeah. So what happened? But that's all fun and games. But if you think about what people did over the last 10 to 15 years post GFCs, they shortened the duration of their fixed income funds. Rates are going up. So I don't want to go buy the 10-year bond because when rates go up, the 10-year bond's going to get hit more.
Yeah.
You know how much money they left on the table over the last
100%.
10 years? So my point is, it's all fine until you start saying, do you have evidence to make a bet? Are you going to move your portfolio? Do you have enough evidence to make a portfolio? I'll give you another one, which I think is more like the roulette example you did, because I think that's apt. So if you look at value growth spreads, so value stocks are stocks that relatively have lower valuations, compared to their peers. I think, Facebook and Google and Netflix in the last 10 years or so, Tesla, they're growth stocks, really high valuations. Value stocks might be things like JP Morgan Chase and, Exxon and things along those lines. Right.
Hasn't done well for 30 years.
Well, 10-ish years, 30 years has done very well. We believe in value. It makes a lot of sense that if you pay less for something, all else equal, it should have a higher expected return, as long as you know how to run a portfolio and capture that. All right. Now, the holy grail in that type of investing is figuring out when value is going to do well and when it's not going to do well. Because just like stocks and bonds, stocks don't always beat cash every year. They lose a few years. Nobody goes up in arms going, oh, we had a negative year in equity market. Stocks no longer will deliver better than cash returns because they're riskier. They deliver better than cash returns, right? So everybody goes, yep, that's part of owning stocks. So value growth, we think about it the same way, but let's say you're trying to figure out when that switch is going to happen. Values had a bad run. Same thing as you were saying earlier. Values performed negatively for 5 years. It's time for a turnaround. It's done 10 years, time for a turnaround. We ran all kinds of experiments you can imagine. You don't find anything. There's no patterns, right? All those runs versus the level of returns and all that don't tell you anything. One of the things that may have a little bit of evidence, but I'll tell you what the problem with that is the difference in the valuations between value and growth stocks. When they go super wide, as they were about a year ago,
100%,
2 years ago, there might be some evidence that says, hey, when they're super wide, going forward, the value premium may be higher. But the problem with that is they can get wider still. People forget end of 2019, value and growth spreads were at all-time highs. Value was getting crushed, and everybody's like, maybe it's time to kind of sin a little and put a bit more in value. It went ahead and went even wider after that because March 2020 happened, right? And so there's no information, but it's similar to going to a casino. So if you went to the casino and you said the odds of the house winning are 51 to 49. So you know how we talk about house always wins, but the games have to be pretty close for you to go and play. If the odds of house winning are 80 and yours are 20, you're never going to go put money in a casino. So let's say they're 51-49, and there's two scenarios. One, somebody goes in there and makes $1 million bets, $10 bets, million bets all over. The odds are probably going to work themselves out. It's going to be 51-49. The house is going to win overall. But if somebody goes and puts down $10 million on one bet and the odds are 51-49, the house gets worried, right? Because now the odds are close enough that the person betting 10 million might actually win. Mm-hmm. The 49 might show up because it's only one observation as opposed to 1 million observations.
Sure.
So I think with value growth and all these spreads, you might have that little bit of an evidence versus value and growth, but it's not enough to go, I'm going to make one bet. Because they're wide enough maybe every 10 years where you look at it and go like, oh, maybe time to make a bet. But you don't have enough information to make one bet. Now, if you could make 1 million bets, then maybe that's worth it because the odds will work themselves out. So the truth is that all these patterns you see, the news media, they're in the business of hyping up the patterns, and because that's how you pick up newspapers. You don't pick up newspapers to say, we don't know anything about what markets are going to do tomorrow. Stay diversified, keep your costs low, and listen to your advisor.
Although sometimes, I don't know how those do become headlines and they do make it in the paper, but it's not often. I get it.
Yeah, but often it's like, ASX will do this today. Oil price is going to do that today. And then people are like, oh, I need to act. I need to do something. And they pick up the paper. So I think we look for patterns as natural tendency, but there's not a lot of information out there that you're able to forecast these type of things. So I often get the question when people find out what I do for a living, they're like, oh, what do you think about the markets right now? And I usually say, if you're worried enough that you're looking at the markets every day, you probably shouldn't be in the markets. Because I don't know what's going to happen next week. Think about next 10 years, 5 years, and you'll be fine. stick to that approach. But everyday headlines. So I don't know if they have enough information.
The example you gave about the guy coming in and placing 1 million bets or whatever, right? Like I get that over the number of over that high number of bets, or if you play for long enough, that eventually the odds will work out, like you said. But it may not be until the last 10 bets that you make that makes it balance up, right? But if I think about that from an investor's perspective, maybe just investors can't run that risk, which is, I don't know when I'm going to get the premium, right? I don't know when I'm going to get a return on value. It's sucked for 20 years, right?
Yeah.
And the evidence, according to me, says is a lousy investment. How long can I sustain my exposure to get to potentially those last 10 bets?
Yeah.
And, we are Australia's an aging demographic. People can't afford to not capture momentum. Let's say, we talk about Facebooks of the world and Amazons and so on and so forth. People naturally are going to gravitate to that because that's what's been working. And quite frankly, even after all of the gains that were made, people were saying this can't continue. It has continued. And we'll talk. I'd love to know your thoughts about that, not now, but shortly. But just going back to taking risk on things like value, sometimes people just can't wait it out.
David Booth says, whenever says, how many years do you need? And he says, one more than you're willing to give. That's typically the case. And to that point now, just to put things in perspective, when we say value is done poorly, nobody's saying that 100% of your portfolio should be sitting in an Aussie value strategy, right? So if you look at our sort of market-wide strategies like Aussie Cores, which are seen as, one-stop shop for Aussie equities or global equities, even after value had a pretty bad decade, these strategies were pretty close to the market return.
Sure.
Right. So,
and why is that?
What? Because they have other things in there. They have small cap focus. They have profitability focus. They're doing a bit around momentum. We pay a lot of attention to trading costs. So those are the things that, like trading costs are not the sexy things to talk about. Instead of me telling you where the rates are going over the next 5 years, where the markets are going, let me take you to the minutia of trading algorithms and how we move money around and how we go to different venues and how a bunch of PhDs sit around and try to tweak algorithms so we can save a basis point here and a basis point there. But they add up over time, right? That's not the sexy stuff, but that's really important because you can control it. You have some control over it. How I design my portfolios, how I manage them, how I trade them, I have some control to say, if I do things this way, I'm generally going to have a lower cost than if I didn't pay attention to that. In my opinion, that should be the bread and butter of every asset manager, because these are things that you have some control over. Where the market's going tomorrow, I don't have control over that. So there I can design portfolios to keep risk in mind, to make sure they're well diversified and make sure I'm invested the right way. So when the premiums do show up, I pick them up, right? And that's to your point about, yes, value didn't show up, but small cap showed up from time to time. And value wasn't negative every year. There were plenty of years when value was positive. It's just over the overall period, it didn't do well. Profitability showed up time to time. So you picked that up, paid attention to momentum. So all those things added up to keep the portfolios very close to the market. So if you think about it from that perspective, to say some investor 10 years ago decided to buy a market-wide portfolio that looked different than the market, because you have to look different than the market to do better than the market. You can't hold the market and somehow magically do better than the market. That looked different than the market, which is a risk. You're saying, I'm going to hold something different than what the market is, and hopefully I earn a return for that. And if I don't, then I want to minimize how bad that outcome is in that scenario. So in this case, because they're well diversified, because they have other things they're relying on, if one thing doesn't show up, then the portfolio still does relatively okay. Now, if those things do show up, then the portfolio does really well. So that's great. So, it's being smart about it. Nobody's saying put all your money into a small value strategy, because I wouldn't recommend that for most people. That's too risky, right? And then the second piece is, I think one of the ways it becomes an issue when market has a good run, you probably know this better than me, a lot of people don't rebalance. You started out with a 70-30 portfolio in 2001. And by the time 2008 arrived, you were sitting on a 90-10 because equities had a run. And you were like, ooh, I don't know if I want to rebalance because they're running, let them run. But you had a 70-30 for a reason, because that was sort of the level of risk that you were willing to take. But then it ran to 90-10 and you didn't rebalance. So when the hit came, it came a lot harder than if you had perhaps moved to a 60-40. because 10 years later, maybe you have less of a risk appetite. So there's a lot of other things that are more important, I think, than getting the level of the market right over the next week or two.
What do you think is the optimal level of rebalancing? So you talk about these asset allocation mixes, which I think takes a lot of time and effort and thought to craft appropriately for one individual's personal priorities and objectives. And whether it's an individual, a family, or an endowment, it's the thought process is the same.
Yeah.
And you've got your portfolio, you're starting to now, you're on a 50-50 and now you're 60-40 in the wrong way, or whatever the case may be.
Yeah.
Like, has Dimensional done any research around what the optimal frequency of rebalancing is and at what threshold? So a lot of people talk about a 10% threshold. If you listen to research affiliates, Rob Arnott talks about momentum, and if you rebalance too frequently, you lose a momentum factor as well. What's Bhanu's point of view on that, or Dimensional's?
To me, costs are an input into that. So if it costs you a lot to rebalance, that's obviously something that you keep in mind. But to me, there's no one-stop shop for anyone. To your point, it takes a lot of work to get to that asset allocation of one person. So to me, it's like, as long as it's not cost prohibitive, rebalance when it makes sense. So I don't know why it makes sense to people to say, when I did my allocation, it was 60-40, but now somehow I'm okay with the 70-30, right? That, to me, it's just like, well, you were at 60-40 for a reason. 70-30 seemed too risky to you. That's why you went to 60-40. So why? Because you've had a bit of a run in the markets.
You're right.
There's a 70-30. And then, by the way, why, if equity is done poorly, like at the end of March last year, a 70-30 portfolio might be looking more like a 50-50. Why would you not go back to a 70-30, right? Because your bonds have done the job that they were supposed to do. They held up really well during that crisis. Equities went down. Load up, go back to 70-30. You were happy taking that risk 2 days ago or 2 weeks ago. Why are you any different today? Now, something might have changed in your circumstances. That's different. But if nothing has changed, so to me, those asset allocations are fairly slow moving over time. A person doesn't wake up one day, and for the most part, and go from a 70-30 investor to a 40-60 investor, right? So to me, that asset allocation should be revised at some sort of a pre-agreed upon basis, just to kind of see, does this still apply to me? Now, when it comes to actually the technical piece of how often do you rebalance, we look at these funds and we rebalance them when it makes sense, so every single day. But that's because we might have some money coming in that day, money going out, that allows us to rebalance.
Sure.
But for most investors, that's not practical, right? To do that every single day. So I think if you use like a quarterly or a semi-annual or annual thing, it might have small effects, but it's not the end of the world as long as you look at it on some sort of a relatively frequent basis, keeping cost in mind. You don't want to let it run for 5 years and get it out of whack completely. I think that's when you get into trouble.
Yeah, I think you get into trouble with that. Although if you let it run, letting momentum run over the last 5 or 10 years might have been a good thing.
Yeah, hindsight, Robert. Hindsight.
100%. 100%.
Hindsight. This is where you get in trouble.
Don't do it and don't think about it that way, is because there's not enough conviction or thought put around the foundations, which is the development, the design of the asset allocation. So if you don't give any regard for that whatsoever, why should you give any regard for if it's gone from a 60-40 to a 70-30? Who cares?
Absolutely. If you can explain to me why you were at 60-40 in the first place, why would you say that you shouldn't be at 70-30 or 50-50? So I think that's absolutely right. I think how you come up with the 60-40 in the first place is crucial, because that same framework you're going to use going forward to say, hey, look, in that framework, these things have changed now. Maybe you're 10 years closer to retirement, or you have decided to retire early, and therefore we need to start taking some of the risk off the table, and whatever. But that framework is crucial, getting it right. I think often the last part I'll add is when people get into mechanical rules around these things, that's when they're useful to have some thresholds to say, for example, if you were saying, if you hit X rebalance, so we'll look at, for example,
once a year.
Yeah. So what we'll do is things like, because they all come with relatively different levels of importance. So to me, for example, that equity fixed split is far more important than Australia versus developed ex-Australia split.
Yeah,
right?
I
Because
100% agree with you.
those are very different asset classes.
Sure.
So if you don't have that, right? So if all of a sudden you go from 16 equities to 17, that's a big problem for me. But if you go from 30 in Australia to 35 in Australia, that's not the end of the world, because I don't have any information about expected returns in Australia versus Europe, for example. They're so noisy that I can't tell you whether Australia is going to do better next year than US or Europe. So, unless you got some tax reasons or something that really you need to be at that number, if you let that run a little bit, not the end of the world. But that equity fixed split, or hey, all of a sudden I've gone from 1 year in duration to 6 years in duration. That's more volatility, and I'm in retirement. I don't want volatility. So things that are important to you, pay attention to those. They should be higher priority than things that are not as important. So mechanical models tend to come up with, here's the ranges for everything, and they're very mechanical. And that tends to sometimes lead to more turnover for no reason, because you're hitting some artificial limit and you're rebalancing.
Like your Australian equity exposure is 30%, you've gone to 35.
Yeah.
And it's greater than 10% allocation, you've rebalanced back down. And
so
and what you're saying is there's no information that's available that would make sense for you to sell down your Aussie equities and bump up your emerging markets.
You should do it anyway, because that's the sort of the level you agreed to. But it's not nearly as important as that 70-30 split up top between equity and fixed. So I think it's just, pay attention to the things that matter more than others, and they're not all the same. And often people get carried away by, I have a 5% allocation to emerging markets and it did this last year and I'm not really happy about it. Their overall portfolio might be up 20% for the year. And it's like, well, that's part of holding a well-diversified portfolio. Some pieces will do well sometimes, other pieces might not. But overall, are you still on track for that goal that you were aiming for? And if you are, then we're good. Don't react to things that are not that important.
Can we talk about noise? Can we talk about drift and asset allocation? And so if we look at some of and this is very US centric, like you look at some numbers that I'm looking at here, you've got Apple, Microsoft, Alphabet, Amazon, Facebook, etc. In fact, I think like 5 of those companies are now in the $1 trillion club plus. Like Apple's sitting at $2.5 trillion market cap. You've got Microsoft at 2.2 trillion. You've got Alphabet at 1.8. Like, it was almost like, the first company that hit $1 trillion was going to be, no one had done it before, but now it's kind of becoming this normal thing. And we're seeing allocations in portfolios, or a desire to move allocations more and more into this space. Very technology heavy. And I guess the question for me is, when this happens, I get that it doesn't last forever. And people talk about, and you read headlines and you read articles that talk about the fact that, you've got 5 or 10 companies that make up 30% of the S&P 500 market capitalization. Which sounds scary, but then you look at the Australian market, we've been living that for the last 40 years, which is, I find it bizarre that people spend so much time talking about it in the US, but you kind of look in your own backyard and you've got 2 companies making up 20% of the market cap, which is insane. So I get my question.
And they're really old companies too.
100%. 100%. And so just thinking through when we look at super heavy weightings towards large cap stocks like this, how long do these things typically last? Because I just can't see how these companies can continue to grow at the rate and the pace they've been growing to what's got them here to this point in time. And if the market, to your point before, is forward looking, the market and market participants think that these companies are going to continue to keep doing what they've been doing. Their earnings are going to continue to grow. Their profit margins are going to continue to grow from what got them from zero to now. I'm just any insight.
It's hard to imagine. Look, the profits of these companies are quite high. They're some of the most profitable companies in the world as well. So I think some of those. So if you look at the last 15 odd years or so, and you look at the returns on these companies, and I'm going to use them to approximate returns on growth stocks, let's say. is one way of saying it. They've been phenomenal. They've done 15% a year, 15% a year, when the overall market's done 10 plus. So value stocks have done 10% a year, which is actually what they've done historically, long term. So it's not that value's done poorly. It's just these companies have shot the lights out. Yeah, these companies have shot the lights out compared to what they've done historically. So you might say, that can't continue. Now, I would agree they're growth stocks, so they should have lower expected returns going forward. They're mega caps, so they should have lower expected returns going forward than a mid cap or a small cap stock. So across the board in these very, very large companies, we're underweight across all our portfolios.
And Bhanu, just before you go on, that's because the higher the price you pay for something, the lower your expected return.
Yeah, all else equal, right?
All else, 100%, all else equal.
What helps you in that, in some ways, for example, you like Apple a bit more than, let's say, Netflix, right? Because that high price of Apple is, on the other side of that, is cash flows. So, right, valuation equation is price is cash flows discounted back, right? So the lower price you pay, the higher that discount rate should be, right? What you're dividing by. But if you have lots of profits, then that lower high price might be justified, right? So you might be willing to pay for Apple what the Apple stock is trading at, because it's got tons of profit. So the discount rate being implied by those profits and the price is actually relatively reasonable. It's high. Now, the situation where you have no profits to speak of, think, Tesla or Netflix, Afterpay, and they got bought out, so that's not a story anymore.
Yeah, but that doesn't stop the share price from going up. Doesn't stop people from participating in that, and doesn't stop people from making money. Yeah, so we can sit here in theory and talk about this is what's supposed to happen in theory. Yep. But
let me translate to the practice. So if the price is really high and there's no profits to speak of, what that's telling you is that there's very little discount rate. So the expected return is really low. Now, what could be happening there is investors are projecting much higher profits into the future, right? Which is fair enough. Tesla, if you believe the hype, they could be worth trillions and trillions, because every car will be electric and it'll all be Tesla. So we don't know. So investors might be projecting really high profits into the future. The problem is having a good estimate of those future profits, which is hard to do. But given all that, that discount rate that the market's telling you is pretty useful information. Now, that doesn't mean that that's a guaranteed discount rate, right? Just because value stocks are trading cheap or at low multiples, so the discount rate's high, it doesn't mean you're going to get that discount rate tomorrow. They might get cheaper still. They might drop further more. Or whatever profits they have might not show up tomorrow, be even lower. So the discount rate was more than justified. Same thing on the growth side. Tesla might actually generate a ton of profits in the next 5 years, and therefore the price was justified. So there's a level of uncertainty associated with all of it, right? But the point here is to say you're building a portfolio, you're deploying capital, you're looking forward going, what's a good portfolio to build if I want to outperform, based on how valuation works, based on what the empirics are showing you, based on what practically, when you think about it, makes sense. You want to underweight some of these companies because they are growth and they're mega caps. Some of them you want to underweight a bit more than others because they don't have any profits to speak of. So we actually look at the relative weight in Apple versus Facebook or Google, or Netflix for that matter. Like Apple's at a similar level of valuation to Netflix, but has a ton more profits. So our underweight to Apple is a lot less than, relatively speaking, than something like Netflix or Tesla. So you do take these things into account, and then you're working on expectations. And you're absolutely right. I can build the best theoretical portfolio that I can think about, invest it, cost-efficient manner, actually hold a real-life portfolio on expectation. I should expect these premiums to show up every single day. But in reality, when I look backwards, yes, over the long term, they're paid off. But day by day, and if you miss one good day, it can have a huge impact on you.
That's right.
So the only way to get it is to stay invested and stay disciplined and stay focused and ride out the rough times. Otherwise you don't earn the good times.
And then if we look at some of the companies and where they're listed, so most, if not all these companies are US listed. And so if we look at the US stock market, you said before that you think it's less important, and I don't disagree with you, less important about the geographical allocation when compared to the risky defensive allocation. Yeah. And so if you had, not that I don't think a lot of people have no exposure to the US, If you've been underweight US, you've been underperforming.
Man, it's been hurting.
Yeah, and how long can you continue to accept that? And conversely, you look at Australia; it's a super concentrated market. It's what 2%, maybe even less now of global market capitalization. You've got Europe that continues to remain a bit unstable. And if we're talking about instability, you look at Asia and the intervention that government can have on stock prices there, which we saw not that long ago in some of the tech stocks.
Yep.
Like, why would you not just plow into the US market?
I'll change. I agree with you. One of the things that I still don't understand is the level of home bias Australians have. When I first came to this country in 2010, it was fairly the norm to see 70.
Were you in the US before that?
Yeah, I was in the US before that. So it's fairly the norm at the time to see like a 60-70% equity allocation to Australia. So you had $100 in stock, 60-70 if that was in Aussie equities. And, that it just was mind-boggling because you left out tons of industries that the rest of the world had. And people made excuses like, oh, if I own BHP and Rio, I have emerging market exposure because they sell iron ore to China. And I'm like, would you rather get your emerging market exposure from 2 stocks? Would you get it from 5,000 stocks? Right? It just doesn't make sense to me that you would want it out of 2 stocks because companies can do stupid things. We've seen Rio do some dumb things lately. So, that's a risk that you shouldn't get compensated for because you had too much money in Rio. So nothing wrong with Rio as a company overall, but the point is you want diversification when you can get it. Now, emerging markets are more expensive to invest in. So I get that. So you take that into account. But I completely agree. In terms of opportunities available, different sectors doing well in different areas, different consumers in different economies, real economies, so on and so forth. Our view is that the best starting place is the market itself, right? You start with market level allocations. And what that would mean is 2% allocation to Australia. I know that sounds really remote to everybody. I see you laughed out loud. I know that's the reaction I get every time. And so that's the starting allocation. And then you move away from that to say, I want to look different than that for good reasons, right? And so good reasons might be I get franking credits in Australia. Foreign investments are a bit, expensive compared to Aussie only. There's exchange rate risk I don't like, or frankly, I just don't like it. And I know that shouldn't be a good enough reason, but I think one of the biggest challenges we have is investors staying disciplined and sticking with their investments. So I say that if having a 40% allocation to Australia means somebody's going to feel good about their portfolio and stick with it, then that may be a worthwhile trade-off, right? I would say maybe 20%. I am a bit hopeful that the number I said 10 years ago, 60-70%, these days seems to be more like 40-50%.
What do you think the number should be, Bhanu?
I don't know. I think so for somebody in retirement with a 0 tax rate, franking credits are worth the most to them compared to somebody else who has a decent, high income tax rate. Maybe they have 40-50% allocation to Australia, maybe more because the tax credits are really worth a lot to them. But for somebody who's not really taking advantage of those tax credits, I don't know, 20%, 15-20%.
I mean, who gives a shit about tax credits when US stock market has returned multiples that of Australian stock market?
Hindsight, Robert, hindsight. What if US market crashes tomorrow and you had a full allocation to US? You're going, see, I told you should have been overweight Australia.
I'm pretty sure the Aussie market would follow very closely.
Well, historically speaking, Aussie market is one of the best markets ever. Like, it's had one of the best returns globally, historically
speaking.
We're
an emerging market, aren't we, Bhanu?
Oh, in some ways we may be, but the point is, like, if you look at that from a hindsight bias, then people go like, yeah, look, that bet's paid off. Having an overweight to Australia has been a very good thing. Now, you don't want to be driving looking in the rearview mirror. I think that previous bet doesn't tell you anything about the future. So I think my prior would be that you have a much lower, like in our funds, we have Australia at about 35%, which is fairly low compared to most other balanced funds out there. And that was a number that we just sort of said, it's a compromise between staying well diversified and not being too concentrated in the portfolio in Australian companies and managing client expectations. Now, the second piece that works in our favor is most of our funds are underweight mega caps. As I said earlier, we think the low expected returns. So some of the concentration issues are sort of somewhat reduced. But if you hold just like a simple Australian market at 60%, you have more money in CBA. I'm pretty sure it's still true. You have more money in CBA than all of emerging markets. Just think about that. You have more money in one bank in Australia with a population of 20 million and 2.3% of the market cap than about 30% of the global GDP.
Yeah, it's.
Doesn't make any sense to me.
I think it's come. I mean, I'm sure when you look at the US, and I think there's been studies done on this. Wherever your home is, you have a bias to your home, and I don't know. Maybe it's familiarity. Maybe it's the fact that accessing offshore markets 15 years ago, I mean, it
wasn't easy.
You couldn't do it. And the only thing you could do, and this business that financial advisors and stockbrokers and any finance person was in, was to sell people stocks. People still do that. It's insane. I don't understand why people still do it. But there are still millions and millions and millions of dollars that are being invested that way. Buying Amcor, selling Amcor. Like, and the narratives that go with some of this stuff, I'm genuinely perplexed as to how people still buy into this.
Oh, look, lot goes into that. Finances are a very emotional topic for people. So I have often met people who view the stock market as a get-rich-quick scheme. They approach it with that mentality. That if I just get a couple of calls right, I'm going to put in a few $100,000 and I'll be set. It's going to be the end of all my troubles. Sounds a lot like I'm going to go put that money on black and see what happens, right?
You should have bought Bitcoin at $30,000, right?
Well, see, the problem is, okay, you have your videos on YouTube. You have social media. I forget what I was watching something. It was a long video and there were like these ads in the middle. Every single ad was some bloke on TV telling me how he could teach me how to trade Forex. How he could tell me how to go in and out of Bitcoin at the right point.
Was it a 19-year-old sitting on a Ferrari?
No, it's actually gray hair and everything. There was one 19-year-old with a yellow Ferrari, but there was a dude with the gray hair, looked very reasonable and trustworthy. But my point is imagine if you're doing a bit tough, you have a tough life, finances are not that easy, and some person tells you, and everybody worries about money at some point, some person tells you, just listen to me and I'll get you out of this. People prey on people that way. So I think that's the danger there. And that's why people often end up making these kind of decisions. But then again, I take hope that compared to where we were 20 years ago, Robert, to your point, international markets are now accessible. A lot of the access to
almost nothing. It costs you nothing.
Yeah, a lot of this has just been democratized, in the sense that you can just log on and buy an ETF or, buy an index fund fairly reasonably. And so I think, and what we really need, personally speaking, is a lot more education at the high school level on these things. I think a lot of people graduate high school or universities without knowing very little about financial markets, and they go into super the very first day they start a job without knowing what they have to do with the money.
And they've got choice with super now, right? And it's
exactly.
Like, how do you make choice with something you don't understand?
So I think that education is the key. More educated you can be about these things, the less bad decisions you make here. But I can totally see how people prey on these things, man. But then even going back to the home bias, I mean, like I said, because of things like international markets are easier to access, people are a bit more educated, they're a bit more, listening about how to take care of their money. The home bias number is dropping. It is down to 50-ish, 40-ish%. And I think hopefully we continue to see that dropping down to 10s and 20s would be where I would say eventually people need to get to.
Yeah, I think it's an evolution. It'll take time, and I think also in the financial advice or financial and wealth management industry, the investment game is being democratized by systematic investing, robo advice, passive investing. People are becoming more and more aware that they don't have to play that game that maybe mum and dad or grandma and grandpa used to have to play with their stocks, and that there is a very different way of doing it. But I think there's a clash there in our industry where there is a cohort that is their value. The value add, or what they hang their hat on, is their ability to be able to short Amcor and go long BHP. And I think that will eventually take its time to again evolve from what's valuable and what is less valuable. But I never thought about the people's circumstances being influenced by, you said, people preying on that. I never really thought about it that way.
Yeah, look, I get plenty of my friends calling me saying, they're in that stage of their lives, they're middle age, they've got a couple of kids, and they're thinking about putting some money away. The house is, they're making the mortgage payments, and they need to start. What should I do with it? And I often tell them, well diversified, set and forget. Don't look at it every day.
That's not what they want to hear, though.
Yeah,
just on that, actually, like for people that are investing, there's so much out there. There are thousands upon thousands of investment opportunities out there. We see number of them either knocking on our door, or we get flooded with emails of performance figures. And man, some of these guys even flouting performance figures when they're underperforming their own benchmarks. Like, it's just the most mind-boggling thing I ever see. Millions of dollars of still flowing into these things. You've got performance fees for investment managers to perform on the upside, but hey, nothing goes wrong when you lose money on the downside. Like, what should people be doing, Bhanu? Like, what advice would you give to people when they're looking at investing and the types of investments they should look at? What should they be keeping an eye out for? What's some of your Bhanu's top tips?
Look, I think for most 99% of the people, I would say diversification is your friend. Anything too concentrated, stay away from it. That's my general rule. If you don't understand it, if it doesn't make sense to you,
but who really understands this stuff? Come on,
look, I tell you, let's go back to 2008. Hey, I've got this, good as gold, AAA rated mortgage-backed security yielding 3% more than if you put your money in the bank. And your bank is AAA rated gold, blah, 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 or US Treasuries, backed by Uncle Sam, go buy that. And this one, just as risky as US Treasuries, you're getting 3% more. Where's the catch? Like, why am I getting so much more for taking no risk?
I just don't think the average person thinks about it that way.
Fair enough.
To your point, the education is...
And I think that's why the diversification is usually a good bet. Well diversified. Index is probably, I hate to say it this way because, indices have their issues, right? But I think their positives are a lot better than holding concentrated single stock portfolios or hybrid securities and some property scheme somewhere and get rich quick scheme. So if you just go put money into a global equity index or a global 60-40, you're 90% of the way there, right?
What about these guys that come to you with, we are an investment manager, we actively buy and sell sovereign bonds, and we corporate bonds, we do this, we do that. And hey, look at our performance. Like, you're not even beating your own benchmark.
Yeah, I mean, to your point, most people don't know what that benchmark even means. So I hear you. I think at the professional level, it's challenging enough to ascertain the drivers of performance of a manager at a professional level. So somebody like yourself,
100%.
I can throw enough numbers at you to confuse you on any performance metric, right? You'll be like, oh, well, I see what I mean, but maybe it's this and maybe it's that. And so numbers never answer it. So I think that's why it's challenging enough at that level, let alone a retail mom and pop level where they're looking at all these hundreds and hundreds of ETFs and products out there, or whatever you want to call it, to say, which one should I buy? And that's why I think start simple and then go from there, take time to understand what you're buying. Performance fees are a good one, to your point. It creates incentives for managers to take risk, right? So if you're looking for upside, your best friend is volatility, right? You just swing the bat. And if you get lucky, you get paid a ton of money. And if you're unlucky, you put the watermark in and then you shut down the fund 3 years later and you walk away from it, right? So you don't really pay anything. You've collected your base fee already, which tends to be high with performance fees, 2% or whatever. You're still collecting that no matter what you're doing. But the performance fee, if you don't earn it, no big deal, to your point. You kind of reset the watermark. And if you don't look like you're going to come back up to it, you just shut down the fund and walk away. But if you get lucky, here comes the Ferrari, right? So I think that's why performance fees at a theoretical level make a lot of sense. Hey, you're aligned with my performance, but I think they might create incentives for people where they try to swing the bat too much because they know the upside is a lot higher than the downside. So maybe you don't want that with your asset.
But presumably,
managers.
some people would want that because that's why they're investing. Because they're taking on risk, and they want someone that's aligned with that same objective, right?
Possibly, but if they get to walk away from it and you are left holding the bag.
Yeah.
So I think and the second piece of that is often those type of strategies tend to be quite opaque. They tend to be, things that don't trade a lot. So it's very difficult for you to see what's going on in the fund. They often won't tell you. So I think if you are aligning somebody like that, you want transparency a little bit as well, which is usually the opposite. So it's figuring out investment manager performance is a pretty difficult topic to begin with. And that's why I think, having broad market, well-diversified strategies, which can be pretty easily benchmarked to something like the ASX 300 or the MSCI World type indices, makes it somewhat easier, at least for people to say, okay, if I could just put my money in the market index, I earned X, and I can see what my manager is doing. If they're earning more than X or less than X, then I know their performance is pretty straightforward. But the more complicated, the more concentrated the product is, it's more difficult to assess why the manager is doing what it's doing. Yeah. So if they do really well, what did they do well? If they do really poorly, what did they do poorly? So it's not an easy task. So I would say if you can afford it, go get an advisor. But if you can't, the general rule would be to go towards more diversified, transparent strategies that you understand what's going on there.
Go buy a diversified index fund as much as you probably don't want to hear me saying that either.
No, I get it.
The easiest thing, right?
In US, we've got a bunch of ETFs launching this year, and we launched a bunch of them. We will be launching more there in the near future. So I think now I can say,
in Australia?
We're looking at it. Don't know yet. If you have a lot of demand for it, let me know. We're taking a close look at it. Australia is good because there's a structure that allows you to launch them without having to launch a new strategy, right? So you can take your Australian core, launch an ETF wrapper, and you don't need to launch a new fund. So it's relatively straightforward. But dimensional, we don't launch strategies for the sake of launching them. We're often led by our clients. So if there are clients who are coming to us and saying we really want ETFs, so we'll take a close look.
Yeah.
But for now, we're just trying to figure out what the operational setup is and all that.
Yeah. It is interesting because the number of ETFs, there's a lot of providers now that can set up ETFs really quick. They get fund flow really quick. So you can go buy a marijuana stock portfolio ETF. You go buy a cybersecurity ETF or a tech whatever it is, right? You can go do these things. And even when we talk to a lot of younger folk, like kids of clients and stuff like that, they're like, "Hey, man, I want to buy this marijuana ETF. What do you reckon?" I'm like, "I got no idea, man. I got no idea."
It's no different than picking stocks. You're just picking themes or sectors, and often it's hard. It's just as complicated as trying to pick stocks, to be honest.
I don't disagree. And generally, the advice we give is, why don't you just start with a real good core portfolio that is just had broad market, Australia, international property.
Yeah.
Just get a nice broad market and then go take some punts, man. If you want to go take some punts on marijuana stocks and an ETF, go do it.
Yeah. Yeah.
But don't try and design a portfolio with, 15% in the marijuana ETF, 25% in the chip maker ETF. I just think that's that it might work out, but I just think you're going to kind of need to build your foundations and get those right first. Not saying don't do that stuff. Go do it, scratch that itch, but you got to make sure the foundation's right, I think.
Yeah, understand that it's on the margins and not the core of your fund, right?
Yeah.
So I think that's the difference between doing that full on versus I've got my investments here, which are going to really harness that power of compounding over time. I'm young. Best thing you can do is start investing right away, right? So put a bit of money away, markets, let them grow over time. But if you want to scratch the itch, like you said, on the side, then go do something. But don't make that the biggest thing in your portfolio. And if you get lucky, great. But if you don't, you're not going to lose your shirt over it. So that's okay.
And don't turn around and point the finger and say, "I told you so."
Well, there's a great podcast called Econ Talk by Russ Roberts, and he had Fama on there. Gene Fama, and this is a few years ago, 5-6 years ago. And Fama's father of modern finance, market efficiency, and this and that. And Russ made a statement which he was like, Fama, Gene, the problem is you've got this 60, 70 years of body of work, right? So thorough, so meticulous. He hadn't won the Nobel Prize then, but he went on to win one. Like, just guys, as good as you can get as an empiricist, as a finance guy. And he goes, some dude gets lucky one year, and he says all that is useless. The markets are noisy. Distribution of outcomes is super wide. Somebody could be just fully punting, make 70% in that year and be like, see, markets are not efficient. Look at me. I made 70% this year.
Yeah.
But that's, again, the distribution of outcomes, you're bound to get some people getting lucky like that, right? But that doesn't mean the whole discipline goes out the window. And that's the challenge with our markets. Somebody gets that, they go talk about it, everybody else goes, I think I can do that too. And then they go take those punts and lose their money. So
no one sits there saying, hey, I reckon I can extract the tooth from you or undertake open heart surgery. Like it's just one of those, our industry. And I think finance and sports are very similar to the extent that you don't have to actually be a professional or an expert. You can just
to comment on it. Yeah.
You can just have an opinion. Right? Yeah. And people take your opinion really seriously. And I think it's just one of few industries that you can kind of have that, unlike those other industries that I talked about. Might wrap it up, man. Bhanu, I appreciate your time. Thanks for joining me today.
Pleasure, Robert. Thanks for having me.